Picture this. You open up an earnings report, and bam, right there staring back at you is a net loss of negative $317 million, right? For a casual investor looking at Calumet's first quarter of 2026, that number might cause absolute immediate panic. I mean, it's a terrifying headline figure for sure. But as we fundamentally know in value investing, the headline literally never tells the whole story.
So that brings us to a very direct question. Is Calumet actually losing money? Today, we're exploring this massive illusion of paper losses versus the actual reality of their operational health. Because underneath that scary negative number, there's a completely different and, frankly, totally fascinating narrative unfolding. Okay, let's dive into this. That $317 million headline loss, it's heavily distorted by massive non-cash accounting items. We are talking $147.4 million in RINs mark-to-market expense, another $102.7 million in unrealized derivative losses, and $37.9 million in equity-based compensation. So what does this all actually mean in plain English? These are just accounting quirks. They're paper losses on future obligations that create this crazy illusion, practically completely obscuring the actual cash coming in and going out the door. Now, what happens when we strip all those non-cash accounting items away? Well, the reality is a positive $50.1 million in adjusted EBITDA for the quarter. Yeah, you heard that right. That is a massive $367 million swing from the headline net loss. The core business is actually generating positive earnings. It's a classic case of why we have to dig deeper. Welcome to The Explainer. I'm your host, and today our goal is to completely unpack Calumet's complex transitional phase. We're going to use the hard data right from their Q1 2026 earnings report, their proxy statements, and analyst forecasts to separate the financial illusions from the operational realities. Let's get right into it. Here is our roadmap for today. 1. Beyond the headline losses. 2. 3 core segments. 3. Montana renewables. 4. Shreveport recovery. 5. Debt and governance. And 6. The analyst verdict. Section 1. Beyond the headline losses. Section 2. Calumet's 3 core segments. So, to truly understand the financials, we first have to grasp what the company physically does. Calumet isn't just one monolithic entity, right? They operate across 3 distinct segments. First up, specialty products and solutions. This is where they make lubricants and solvents. Second is performance brands, which includes familiar names you've probably seen on store shelves, like True Fuel and Royal Purple. And third, Montana/Renewables, which focuses on sustainable aviation fuel and asphalt. In total, they're selling over 1,900 different products to roughly 2,400 customers. It's a highly diversified, real-world physical operation that completely grounds the financial data we see. And this brilliantly illustrates the actual earning power of those physical units for Q1. When we break it down, specialty products acted as the heavy lifter, generating $44.3 million in adjusted EBITDA. Performance brands pulled in $12.6 million, and Montana/Renewables brought in $10.2 million. Section 3. The Montana Renewables Engine. Now, to really grasp the future potential here, consider this quote from CEO Todd Borgman. Late in the quarter, we saw the renewable fuels market fundamentally transformed following EPA's long-awaited Set 2 RVO announcement. What he's highlighting here are absolutely critical regulatory tailwinds. The EPA's announcement provided some much-needed certainty, and it's fundamentally transforming and improving the margins for biofuels across the board. It's a real game changer. So why is Calumet pivoting so aggressively into sustainable aviation fuel, or SAF? Well, it's all about the premium. They've secured evergreen contracts for SAF that command a massive $1 to $2 per gallon premium over standard renewable diesel. It is an incredibly lucrative shift in their product mix that capitalizes on a high-demand, low-supply market. You really can't ignore margins like that. And they are scaling this up fast. They literally just completed their MaxSAF 150 expansion in early May, which is expected to bring a 4 to 5 times volume increase in sustainable aviation fuel. Just think about that scale. On top of that, they've secured a massive $1.44 billion Department of Energy loan guarantee. This funding, paired with the expansion, is setting Calumet up to be one of the largest SAF producers globally. It's a huge operational reality that those paper losses we talked about earlier completely ignore. Section 4. Shreveport outage and recovery. Of course, it hasn't all been smooth sailing. Let's look at a major recent operational hiccup at their Shreveport facility. The culprit? Organic chloride contamination in their crude supply. Basically, some bad feedstock gunked up the system, forcing them to take the plant entirely offline to fix the equipment. It's a stark, real-world reminder that financial spreadsheets just don't account for dirty pipes. That unplanned outage was a big deal. It cost them 750,000 barrels of lost production. To put that into perspective financially, management noted that this lost volume equates to an over $30 million missed opportunity for the quarter. Ouch. While they did resume normal operations in early April, this absolutely shows the real-world operational risks that can bite into that adjusted EBITDA we praised earlier.
Section 5, Restructuring Debt and Governance.
Let's move to and see how this builds a safety net for the company moving forward. They took major decisive steps to de-risk their balance sheet by retiring their notes due in 2026 and 2027, and then issuing $405 million in new notes due in 2031. By doing this, they've completely eliminated their near-term debt risk, pushing those maturities out a full 5 years. That gives their Montana Renewables engine plenty of time to really scale up without the crushing pressure of immediate debt walls. Behind the scenes, they've also completely overhauled their governance. In July 2024, they transitioned from a master limited partnership to a C Corp, which seriously broadens their potential investor base. Furthermore, their 2026 proxy statement reveals that executive pay is now tied 60% directly to adjusted EBITDA and strategic initiatives. So the absolute crucial takeaway here is that management compensation is now rigorously tied to actual operational performance, not the paper earnings that get wildly distorted by mark-to-market accounting rules. Section 6, the analyst verdict.
So, how is Wall Street digesting all of this? Looking at the consensus from MarketBeat, analysts are currently sitting in a perfectly neutral to cautious stance. Out of 6 analysts, we've got 1 sell, 4 holds, and 1 buy. The average price target is $36.75, which sits right near the current trading price of $35.82. Basically, the market seems to be taking a very strict wait-and-see approach right now.
Which leaves us with this final, provocative question. With their near-term debt completely extended to 2031 and the Max SAF expansion now officially online and ready to capture those massive premiums, is Calumet's Queen transition fully priced in? Or is the broader market still way too focused on the illusion of those paper losses, completely missing the long-term operational reality we just uncovered? It's definitely something to chew on as you review their next quarter. Thanks for joining me on this explainer, and keep learning.